Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. It's just the perfect day to have our guest on the show today. The case for a chat for Vinay Jaising is multi-pronged. Of course, the rising yen spelling red for any kind of risk-on strategy and leading to a risk-off. Are rate cuts imminent though in the US, as the US hiring and the US data is showing signs of a slowdown, and will we see more of that? I'll dwell upon that a bit. And of course, we talk about what's happening to global tech and Indian tech in that period as well, because as we speak, the worst hit index across the world seems to be, after the Japanese markets, the Nasdaq. Vinay Jaising joins us on the show to talk about all of this and more. Vinay, great having you as always, but more so today because it's just coincidental that we have you, but I wanted a guest who has a great insight on what happens in the global arena, and by virtue of your previous role, and I'm sure your current role as well, I'm guessing you have that. So would love to understand, Vinay, what is causing the flutter according to you? Because this, since Friday, when I'm asking people about whether it's the US data, whether it's the yen carry trade, or whether it's geopolitics, and it could be all of the above, but people are still choosing sides and saying maybe the yen carry trade doesn't have as big of an impact as at least I was making it out to be. I would love to understand your thoughts.
Sure. Thank you so much for the opportunity. It is a perfect storm and a great day to chat up with you as well. Pardon me if I don't do justice because there's no real answer to what you're asking. But let me make an attempt. Did we not know interest rates would be cut this year? The answer is yes. And when the moment of truth comes close by, that's the time when the market corrects. Now, despite knowing the interest rate cut, if I were to go back just 2 to 3 days, Nasdaq was up 14%, CYTD 20% last year, and growing at a CAGR of about 15 to 16% in 5 years. Now, if you keep that in mind and you start seeing how Nasdaq fell by about 2.5%, and even the futures of Nasdaq is down by about 2 to 3%, what you're saying is, despite all that, CYTD, Nasdaq would be up 7 to 8%, even if there's a correction in the future. So, a lot was priced in the market. The market was looking at euphoria, and actually, when they realized interest rates are being cut for the reasons, which is there is probably a global slowdown coming up, that is what now investors are grappling with. So stocks or companies which have done very well, where valuations have got frothy, be it Magnificent Seven or otherwise, they are being questioned. And I think that's the right thing. These are healthy corrections because you're cutting interest rates in US because there's a problem, not because you want the economy to grow a lot faster. So I think that's the first point. Going to the second point, what is Japan doing? Japan is raising interest rates. That means the yen, which had got depreciated substantially, there are question marks of what will happen to that future. And it's led to Japan correcting by as much as 17% in the last month. So one of the most preferred markets last year, because you were seeing inflation come up, earnings growth come up. Now, courtesy, interest rates moving up, and question marks of yen versus the other dollar is creating another problem with the Japanese market. So that again is not become a safer haven. So now the question really arises is, which is the best performing market in the world? I'll reach your question on IT, but which is the best performing market in the world? And that leaves you to India, which even after this correction is up 19 to 20%. I'm talking about MSCI, CYTD. So, people are probably looking at a risk off trade as against a risk on trade. Yes, valuations are important, but where do you see relatively good earnings growth and liquidity coming into the picture? That's what people are looking on. As far as IT is concerned, if there is a global slowdown, you're already seeing the interest rates of US, come below, the 10-year rates come below 4%. Less than 6 months ago, they were around 5%. So you've seen a sizable change in the interest rates, which means, yes, interest rates are imminent for the wrong reasons. Cuts, and that would lead to probably slow down in the order books for IT. So people who are hopeful that the worst is behind them may be surprised. So we come from that camp actually. We are underweight the IT sector for quite some time. We know the absolute valuations are not extremely bad. They're pretty much where they are. But yet, they're still at COVID levels, post-COVID levels. So we think, pre-COVID levels, my apologies. So we think it's a nice time to be underweight IT as we talk.
Okay, and I'll peel off these layers one by one. But I just want to, viewers, take your attention to a particular set of data points and the reasons. So a lot of you must be thinking, why is it that the markets are so choppy? So key decision, as Vinay said, BOJ's decision to raise interest rates took the yen to the highest levels in a really long time, at least since February, March, if I'm not wrong. The move, of course, triggered the unwinding of the yen carry trade. Effectively, people or global investors would borrow in the Japanese markets because the interest rates would be low, invest in other markets, take the cream, and revert it back. So as long as interest rates and currency stays low, I'm simplifying this because we would love to get more of Vinay, but I'm just laying it out here. As long as the interest rates and the currency stays low, it's a very good trade to execute. As interest rates move up and currency moves up, it becomes a problem because the rate differential and the currency differential eats into your profits, and I think that is the sign that we're seeing. So we've seen a bit of a global sell-off in the last 48 trading hours. As we speak, the Nasdaq futures are down under the 3%, and investors probably should expect increased market volatility in the near term. The point that I want to ask Vinay Jaising though is the next plate, and the next plate says what now brokerages or global think tanks think of what the Fed will do. So Citi expects 125 basis points cut by the end of 2024, JPM about 50 basis points cut, each in September and November, so about 100 basis points. BofA sees rate cuts starting in September versus December earlier. So clearly, there is now a belief that interest rates will start coming down very, very quickly. Now, Vinay Jaising, we know that since the COVID days at least, the Fed has been the principal mover of risk assets, particularly equity markets globally, and thereby even in India. If the Fed were to cut starting September and show that aggressive stance, because it's at 5.25 and can afford to, do you think that's a bit of arresting the fall kind of a tool for equity markets globally?
So, yes. So I think if you look at the 10-year chart, it's exactly what you're saying, which is, close to 4%. So 5.25 is already being factored in the bond market of having a cut of as much as 100 to 125 basis points. 3 months to 4 months, we don't need to be as cute as whether, you get 125 in 3 months or 125 basis points in 4 to 5 months. But, I think that will become consensus. Remember, 6 months ago, we were talking about 7 cuts and even more aggressive cuts coming in totality. I think that's behind you. Probably a 6-month forward comment of 4% interest rate in US for 10 years as well as a 4% interest rate for Fed of 4 to 4.25 is a lot more real. Now, when that happens for the first couple of months, my bet is people will realize why that has happened, which is, you're seeing delinquencies and mortgage rates, you're seeing credit cards, payment problems happening from the retail customer, you're seeing capex slow down in US. And when you see all these things getting added up, the market will probably, short-term correct before they realize, guess what, the cost of capital is going down, which is good news for the market. But that, I think, will be 3 to 6 months forward. So 6 months forward, you'll probably see the market a lot more stable to moving up. But in the next 3 months, I see a lot of volatility in the global markets.
Okay, volatility with a downward bias, or could the Fed action help arrest that downward bias? Sorry, I'm asking that question again, but I just want to get it out of the way and get it clearly.
Sure. My bet is it's volatility with a downward bias, just because the market, especially depending on the market you're talking about, just because the market, let's say Nasdaq is still up 10, 11% in like 6 to 7 months. It's had a wonderful run in the last 2 to 3 years. So, that arresting some correction in terms of valuation probably is warranted. So I would tend to believe in the next couple of months, you're a little more conservative on the market than aggressive.
Okay. Vinay, a word on flows. I'm guessing you look at them too very closely. Now, 2 aspects. One, rate cuts in effect should be conducive flows. Plus, we did some analysis that in the budget week, we did this analysis of what kind of gunpowder were the Indian mutual fund industry sitting on. That at least our analysis seemed to suggest about 1 to 1.25 lakh crores. Now, what role would flows play if indeed the markets become choppy or volatile with a downward bias? I heard you say that it depends on the market. So if the global markets are doing this, India may not have downside bias, but it will certainly have volatility as well. So could Indian markets downside be a lot lesser relatively because of the flows aspect?
It's a beautiful question. I had a table made for you. Let me talk about global liquidity before we come to Indian liquidity. If I were to look at peak liquidity or M2, in the market, if I just take China, Eurozone, Japan, and US, that was somewhere close to $92 trillion a couple of months ago, 6-7 months ago. Now it's down by $5 trillion. It's at about $87 trillion. The maximum downflow is actually, the maximum reduction has happened in Japan, followed by $1 trillion in Europe and US. It's very marginal in China. So that also tells you what the reason why I mentioned that, volatility with the downward bias could happen in US. Now in India, it's exactly the other way around. You've got a couple of engines firing. The first engine firing is what you just mentioned. Our estimates, we have Dharmendra, our data analyst, who helps us a lot with looking at this data, and his calculation suggests about 5 to 5.2% is the overall percentage of AUM which the mutual funds have cash on hand, and that's about 1.5 lakh crores. That's a lot because the AUM itself has gone up so substantially. At 1.5 lakh crores, you're talking about 15 months, my apologies, of SIP data coming on a month-on-month basis. So they have a lot of gunpowder. Now, if you look at where this ammo gets normally used, normally the mutual funds are a lot more in the small cap space than the mid cap space and the large cap space. So as far as I'm concerned, the domestic liquidity followed purely by mutual funds. I'm not even talking about retail India, which is also singing, today about 1 to 1.1% of overall GDP comes in from retail India and shares and dividends. So that's another $30 to $35 billion coming on a yearly basis. So I think retail and domestic money, be it through mutual fund or directly, is going to help the market have a cushion wherever there is a fall. So I would tend to believe that, in the shorter term, you may see some corrections, but that's a time wherein domestics will start buying substantially. And then earnings growth, this time the earnings growth results which came out was tepid in my eyes, but the earnings growth will be equal to, what you would expect in terms of absolute market returns in the times to come.
Okay. One more question, and we kind of focus on the macro a bit before we talk about the micro in the other side of the break, Vinay. And that is this, that there was a belief that a China recovery will help base metals, will help anything related to property related demand quite significantly, and might even help exporting sectors like chemicals. Now I wonder if the talk of a global slowdown plus the very choppy China data puts paid to these kind of hopes on metals, on chemicals, some of these global sectors.
So let's break the sectors up into two. But as you rightly put it, if China would have grown, things would have been far more interesting for both the metal sector as well as the chemical sector. But between the two, and again, I'm putting the pricing of the stocks into the picture as well for India, we would be a lot more bullish on the chemical sector because, they've corrected substantially, and the depends on the product you're talking about. The sales realization per ton for a lot of the chemical names are closer to the bottom. You've seen a good rain. You've seen a good, I would say, concerns of El Nino, La Nina, they are behind you. So that should lead to even agri growth as well as chemical growth, courtesy domestic formulations do better in India. So for us, chemicals, we'll have a bias over the metal space, but in the metal space there are some, I would say, interesting names which are not directly metal related. They are more related to recycling, where we are looking at in a very big way. But our bet, because of what's happening in China and the global slowdown, our bet should be more on chemicals because their sales realization, their EBITDA margins are close to the bottom, and you can see upsides coming in on there. And so though the P may look a little higher, when the stock price, when the earnings are so low and they're set to move up, you may actually see in the next year or year and a half much better days for chemicals. So nice time to nibble and buy these names.
Got it. Okay. Were you sitting on some gunpowder on your portfolios? And if so, would you start deploying it starting today, or are you waiting for a valuation number? I mean, I can only correlate it with the number on the Nifty, so I'll use that as an example. But are you waiting for, say, for example, the Nifty to touch 23,500, 23,000, 24,000, what have you, before you start deploying? Or are you selectively already deploying if you are sitting on gunpowder dry?
So, we're sitting on under 3% of cash. We strongly believe, it's our duty to probably buy cash proxies when we want to, because lots of stocks keep on doing well as cash proxies as well. We have just under 3% currently. Having said that, whenever we get cash, including this 3, we are deploying it as we talk. We think there are a reasonable amount of spaces as absolute stocks. Don't look at the indices, but as absolute stocks where you can keep on nibbling and making the position stronger, especially if there are corrections. And that's what we're doing currently.
Okay. Point well noted. So, Vinay, what is it? I mean, the last time that we had spoken, you had spoken about a very interesting set of businesses and sectors where your bets came from. Is it more of the same, continuing where they were, or has this earnings season prompted any changes in sectoral allocations?
So I don't think it's the earnings season or even the budget which has made us make changes, but it's just because of our outperformance and some stocks which have done so much better in capital goods and industrials, whereby what we've done is we've added some, value added metal names, though I said, our metal as a space would not do very well, but, you have some recycling space in metals, which are very good ESG stories, which we are looking at, and healthcare and specialty chemicals, we are betting on that as well substantially compared to where the market weightage is. So these two spaces, we are incrementally increasing our overweight position. We will still be very, very overweight capital goods and industrials. Given a chance, we're keeping on still cutting down our IT space, energy space, even financials, we are relatively underweight, though the financial sector had, I would say, not a great result, but not a bad result. But mostly our calls have been taken more so for the medium to long term, where we are seeing where the government is spending money and where we are seeing, where the company's return on capital employed is substantially higher than its past, and where we are seeing, growth at reasonable valuation. So these are the parameters which we are using when we are buying any of these sectors.
Mm-hmm. Okay. The commentary, Vinay, from some of the rural focused companies seems to be turning at the margin. Has that enthused you at all?
In the rural front, I would say not just rural, but rural and semi-urban front, what's enthused us in the results, I would say, is the housing companies. There we are seeing, even if you were to look at the budget, there we are seeing, the amount of inflows with the government is putting it in PMAY being substantially higher. So that's where, we are betting a lot. So even in the banking stocks, we're looking more at the housing part. But pure rural play, pure FMCG plays, we are relatively avoiding it. Even when we look at FMCGs, we're looking at some bottlers, which have been doing extremely well, food and drink company, which have been doing extremely well even historically. Adding to that, some ammo and consumption, but, that's not rural led. We're looking at just consumption growing just because the reach is increasing of these companies. And then, you have, I would say, technology run consumer names, which we are looking at, in the food chain. So for us, we are not looking at rural being a big rate of change of earnings for any companies, because, if you make the change of earnings from 4% to 7 to 8%, these are cash proxies for us. We are buying growth. For us, if you're buying growth, we prefer looking at companies which have much higher earnings momentum. Case in point, companies like, let's say, Varun, companies like, let's say, Zomato, companies like Trent in the past, wherein the growth is just getting stronger and stronger. Those are the names we keep on studying virtually every day.
So, wonder, Vinay, I was going to ask you about banking, but I'm tempted. We have a minute and a half left. I'm tempted to ask you about Zomato, not as a stock recommendation, but just as what the business is doing.
It's crazy, right? You can buy me coffee sitting in your office just by a pull of a, plug of your hand, and I'll get some good Starbucks coffee sitting out here. So that's one thing it's doing. It's making every restaurant, every room into a restaurant, to keep things better. It's using the telecom concept, I think. What it's doing is it's increasing the ARPUs which an investor is spending by telling them, if you want the products fast, you should start paying us an ARPU, become a gold customer. And technically, what they're doing is they're increasing the ticket of what you're giving them purely for the service they're doing. Plus, they have wonderful tie-ups with the restaurants. So, probably they get supply a little bit faster when their orders go up, and, people are consuming more. So the ARPU of a single investor or single consumer for the products it's having is increasing. So if subscribers grow up, the ARPU per customer goes up, and obviously their margins will go up because, you don't start spending more on costs. So at one end, Zomato is doing really well on its core business, which is, I would say, transmitting food. But then the other end, even Blinkx, they're doing pretty well out there. They're increasing their gamut out there. Earlier it was just, I would say, packaged products. But, I won't be surprised as they're keeping on increasing. They'll become a full-fledged, e-commerce network down below there. So both these together are a perfect engine for Zomato, in the future to start growing aggressively. As it's done in the last couple of quarters. So, 25% plus top line growth, a much higher EBITDA growth, and the path to profitability in 2 years. I think all these are making investors very, very, positive on looking at the company like Zomato.
Got it. Okay. Well, Vinay, I will take your address from our team, and coffee, whether Starbucks or otherwise, is on its way to you today or tomorrow. Thanks so much for joining in today.
Cheers.